There are two main reasons that companies don't pay enough tax, or as much tax as some people think they should. We might call them the Amazon problem and the Apple problem. The Amazon problem is the growing number of big companies that don't report much profit. Amazon had sales of $230 billion last year, but its net profit margin was less than 5%, keeping its tax bill low. Amazon keeps prices low, and it reinvests heavily in internet and real-world infrastructure, keeping rivals at bay and depressing profit. Uber and Netflix are even more extreme cases. They are transforming their industries and making little or no profit at all. The Apple problem is that highly profitable companies can use legal accounting schemes to shift those profits to countries with low taxes. In Europe, for example, many companies have funneled royalty payments towards Ireland. Apple paid an 18% income tax rate globally last year, despite rates in excess of that in many key markets. What to do? One solution getting attention lately is to tax companies on revenues rather than profits. This is a bad idea. Not all low-margin companies are avoiding tax after all. Think of grocery stores or early-stage startups. Without a revenue tax, the Amazon problem is hard to solve. But time may help. Investors want to see profits eventually. Amazon itself is growing more profitable recently, and Uber and Netflix will have to follow eventually. The Apple problem, on the other hand, is solvable with a destination-based tax system that taxes profits in the countries where goods and services are consumed, not where they are produced. The biggest barrier to a destination-based system is that it would require international cooperation to keep loopholes closed. And that is another reason to regret that international cooperation is at a low ebb in 2019.